welcome to the chapter one of the course. All right, so market structure is the first thing you need to understand. In as much as we are trading uh, different strategy, as it were, the most important thing is market structure. If you lack market structure, lack understanding of market structure, it will be impossible for you to actually make profit. So, of course, the basic market structure is something like this. We have higher highs, higher lows, higher highs, right? But these higher highs will have a break here. But you must also understand that price will not just come like this, right? But price will do something like this, retraces back, right? To mitigate these zones. And usually these zones will be our key levels, which we are going to learn about later. And probably this will be A shapes. And of course, if the retracement is very deep, it's going to reflect on this, which is our V shape key level. And also, um, for those of you who have a bit of SMC background, you'll notice that this is actually the inducement, because for every break of structure like this, the first pullback is usually inducement. So if we have a break of structure here, for example, and we now have a pullback here, if we say a pullback here, for example, right, the inducement will move from here to this zone. So this becomes a new inducement. So you might be asking, why do we need this? We actually need structure when we start to look at our MSN arrow levels, right? It's very, very important. Inducement is very vital. Okay, so that's just one thing I want to share with us. So before we move on, we need to understand that in market structure we have both the impulsive and the correction structures, right? So when market momentum becomes very strong, whether moving up or downward, this intense but often unstable price action is known as an impulsive move. What does that mean? This is what I mean. If price is bullish, you will notice that the price action that push up like this will be high. The ones that come low will be very slow. The one that push like this will be strong. The one that retraces will be slow. This is exactly what we mean. So this one, the ones here is impulsive, while the ones that retraces back is the correction. All right. So to put it simply, during an impulsive move, major players like institutions and banks are fueling the surge in buying and selling pressure. Now, this is what I mean. In every swing level, there are buy stops and sell stops in every swing level. Okay. So if we have a swing level here, for example, and you took a buy here, you did not just take a buy. Immediately you took the buy here, your broker also took a sell here. So if you took a sell here, your broker also took a buy here. It is the equivalent of the market execution that you did that will determine whether market will push down or not. And as a matter of fact, that's what's giving us the leverage to take our trade or not. So that's what leverage is all about. So for example, if your broker have one to unlimited leverage, for example, it means that with your little amount, let's say $10, you can be able to place a $1,000 worth and even more. That's the meaning. All right, that's the meaning. But if your leverage is like maybe 1 to 10, especially those in the US brokers, very funny people. US brokers, their leverage system is like 1 to 3. Can you imagine? 1 to 3. Do you know with 1 to 3 you cannot place $100 account? Like you cannot place trade on $100 account with 1 to 3, even 1 to 10, right? Now, why do you need this information? This information is important because you must understand that anytime you are taking a short trade, the market makers are involved. The market makers are involved. So, and that's what we call buy stops, and those will become our potential liquidities in the future. So let's say inducement is taken here, right? Price takes it, mitigates a level, and what happens? Price continue to go to the upside to do what? To sweep all these liquidities. Now, take note of this. Price move from higher liquidity to lower liquidity. But most time they've taught us, most ICT traders have said that price move from lower liquidity to higher liquidity. That's not true. Price move from higher liquidity to lower liquidity. Let me give you an example. If you have $100, for example now, and you have a $10, if you cancel them, which one is going to cancel the other? Right? Let's say you have this is $100, right? Let's say this is $100 and we have a $10, and we want to cancel. Which one will cancel which one? Okay, this zero cancel this zero. How many will remain? Will remain 10, right? Now listen, so long this 10 is remaining, if this 10 is remaining, it is this 10 that will move to go and take the zone that does not have liquidity. I don't know how we explain this to you, but you need to understand that price move from higher liquidity to lower liquidity point. And of course, that's what we call let me show you something. I wish I had the plain sheet here, but of course it's cool. So you can see this, right? Now you see these people here, these are the passive sellers. These were the passive sellers. All right, these are the passive sellers. They are passive orders here, passive. Then the price that is coming to take out this low is what we call the aggressors. The aggressors, they are the ones that will swallow up this. So the price that is coming to take out this high, if it is not enough, is not going to swallow. Price will not retrace back. So that is why if you have the higher time frame key level, for example, you have a weekly time frame rejecting weekly time frame, it is not going to reverse against this low except we have an opposing weekly storyline. So that's the idea of what I mean. So the opposing weekly storyline simply means since you are buying, the equivalent sellers have entered the market, right? So you need this information. You need this information. It is very, very important. I know you want us to go to the fancy stuff. Of course, we'll get there. But I believe this is very, very important. Okay? So you must understand that during the retracement phase, retail traders engage in buying and selling within a confined range. And of course, this is what we'll be trading, right? We don't have the amounts to be trading and be dragging price with the big banks and the rest. However, that does not mean that we're not going to be catching big moves. But the fact remains that we are not going to be catching moves like for weeks, probably just for a few days. All right. So and that's that. So I just wanted to read through. Now I'm going to break down how this pattern appears and how you can identify this effectively. All right, so let's go to the next one. Now this is an accurate example of what I just explained. Now, why is this very important? This is very important, guys. Very, very important. So this whole move here is what we call the impulsive move. This whole move is impulsive. This whole move is impulsive. Okay, so for price to move like this, we are bearish, right? So this whole move here like this, the one that has the solid lines, the ones that have the solid lines, these are our impulsive move, and the ones that have the dotted lines are the corrective move. And usually this is how the corrective move works. Ouch. This is how it moves. It moves like this, all right, into probably a key level here and push down, break structure, probably takes an inducement here, all right, and is going to do something like this, mitigate a key level, the same thing, right? So this is exactly what we mean by impulsive and corrective move. So this is a chart example of what I just explained. As you can see, we have price pushing to the downside impulsively, right? and this push to the upside, this is a correction. Now, what do you notice on this chart? One of the things that you are going to notice on this chart is that for the impulsive, the candles are usually bigger. The candles are bigger. Why for the correction, the candles are smaller, right? Now, this is very important. So you see, this impulsive move, this is correction. And how do we know that correction is completed? First, that's why we need to understand our storyline. We need to understand the story. Very important. Okay, and we have what? Look at this. This is a key level. This is a key level. You see that? So the correction came and retraced from a key level and continued the impulsive move, broke structure, corrected again. What? Key level. Right? Key level, key level. We are going to get there, and we have the correction right there. So I hope this is clear enough.